The share of this session doesn't really need for a long introduction to this audience. Professor Karel Van Hulle gives lectures at University of Leuven in Belgium and at the Goethe University in Frankfurt, and a lot of others, but those are the main ones, I would say. He is a member of the insurance stakeholder group of EIOPA and a member of the Public Interest Oversight Board. And until 2013, Karel served at the European Commission as head of insurance and pensions. We like to call him the father of Solvency II. And Karel, you also always answer present to our invitation, so many thanks for that. And I think I can say you do really appreciate being in company of mutual and cooperative insurers. So thank you for being here, and I hand over to you immediately. Thank you.
Thank you very much, Hilde. It is my pleasure, ladies and gentlemen, to be here today at your conference. And as Hilde indicated, I am a little bit aware of the mutual spirits and culture during my regulatory years. And I was thinking how to introduce the session this morning, and I thought maybe I should tell you a story from the time that we were developing Solvency II. It was this conference that we were organizing, and there was a group of lawyers and a group of actuaries that were traveling to the conference. And of course, the lawyers are very law-abiding citizens, so they went to the train station to buy their tickets. And the actuaries, of course, very versed in risk management, they had already developed a little internal model, and so they decided to buy for the whole group only one train ticket. So they board the train, the two groups, and when the train manager enters into the carriage, the actuaries run to the toilet, lock themselves up. And of course, the train manager, he knocks on the door, and he says, "Ticket, please," and they shovel the ticket under the door. The lawyers are impressed. So on the return journey, the lawyers say, "Now we've learned so much about risk management, we're going to do the same thing." So the lawyers buy one ticket, but the actuaries became smarter. They had even made a better internal model and decided not to buy any ticket at all. So they board the train, and the lawyers immediately run to the toilet and lock themselves in the toilet. After which an actuary gets up and knocks at the door. "Ticket, please." Well, that, ladies, is a real mutual spirit that should guide us. Let us now go maybe to some questions. Can I have the questions? Yes. I'm going to ask you to answer these questions as a lead-in to our panel discussion. Which of the following risks is the highest on your agenda? Is it regulatory risk? Is it a lack of capital? Or is it a low interest rate environment? I don't give you the option of saying all of the above. So you must decide. That's what I try to do with my students too. Take a decision, ladies and gentlemen. We want to know. It's going down slowly, like the interest rates. Are we getting there? Well, very interesting, because the topic of our discussion is capital. And you see that you all rate that as a less important issue. Very interesting, my fellow panelists. Keep that in mind when you make your presentations. Let's move on to the second question. The second question, please. This is about testing your mood. I am optimistic about the future of the mutual sector. We talk about the future at this panel. You agree, you disagree, or you just don't know. Please answer the question. You only have 3 options this time again. We want to know that, because we're going to talk about your business model in a minute. Fantastic, ladies and gentlemen. That is great, because that is actually the message that I was going to give you in my presentation. So We agree. That is great. And let's then move on to the last question. I only ask you 3 questions. Gabriel Bernardino is not here, otherwise I wouldn't have raised this question. So which of the following institutions do you like the most, or you trust most? Is it your national supervisor? Is it EIOPA? Is it the European Commission? Or none of the above? Now you have a 4th option. Doesn't mean that you have to go for the 4th option, but I would like to have a clear message. I promised Gabriel that I would inform him about the result of the vote. What do you think? Well, this is incredible. I mean, are you really saying that? I can't believe this. No, I'm not going to tell Gabriel this. I will tell Gabriel that he had the 4th option because only 2.6%. We need to talk about that, and we will do so in a minute. But before I start my presentation, I would like to present the people that have joined me on stage here. First of all, Aurélien Dubois. He's a qualified actuary and worked with QBE since 2010 in the analytics department as a senior technical advisor. Next to him, we have Martin Shaw, who is chief executive of the Association of Financial Mutuals, a position that is held since the launch in January 2010. And last but not least, we have Helena Torlin, who is general counsel for the Scandia Group and for Scandia Mutual Life Insurance Company, a position she took up in March 2016, which is fairly recent, if I can read that correctly. So, ladies and gentlemen, let me now start with my presentation. I'm going to look at life as a mutual in the world of tomorrow. The present economic environment is challenging. And not only for mutuals, it is challenging for all insurance and reinsurance undertakings. It's actually become extremely difficult to provide insurance in a low interest rate environment. Solvency II provides for certain accommodations for mutuals. You're very aware of that. And as Gabriel indicated yesterday, the complexity of Solvency II is moderated to some extent through the principle of proportionality, which is a key element of the regime. And it's very important, if you listened to him yesterday, that in terms of the future developments of Solvency II, by the way, it will not become Solvency III, it remains Solvency II, but the future review will take care also of the principle of proportionality to give it a little bit more meat to the bone. It's a principle-based approach, which is a challenge for supervisors and regulators, and I saw your votes of confidence in EIOPA, ladies and gentlemen. You have to understand that for the supervisors today in Europe, it is not easy to work with a principle-based regime. They want clarity. Also, the insurance sector wants clarity, and that leads often to more regulation. It's a uniform regime. There is still gold plating going on, and as a member of the stakeholder group of EIOPA, I think I need to tell you that if you have the feeling that something is not working well in your sector, in your country, that your regulator is overdoing things, send a message to the stakeholder group of EIOPA so that we can then, amongst the stakeholders present at that stakeholder group, have a look at these issues and discuss them with EIOPA so that we can bring that to the fore where it can be discussed. So that stakeholder group, you Google the website of EIOPA. I've said that many, many times. The first thing to do as an insurer when you get to the office in the morning, you click on your computer and you Google EIOPA and you look what is the latest news from Frankfurt. The past. It all started with mutualization of risks. The sector was dominant. You know, in many areas of the economy, mutuals and cooperatives were thriving. Demutualization caused by social security developments, so the state was taking care of things. The business model has changed. Some insurers wanted to do other business than just insuring and needed more capital, and this led to demutualization that you are familiar with. The present is developments that affect all the insurance companies. the low interest rate environment, will it stop? Money isn't worth anything anymore. What a message we give to the people. Maybe Karl Marx was right. The introduction of a risk-based solvency regime is, of course, a challenge. And then, of course, the question is, how do I adapt my business model? It is obvious that you can no longer sell guaranteed products with high guarantees over 30 years when your return on investment is 0.5% or negative. It is a major issue, so companies will have to change their business model. And that's not because of Solvency II, it's because of the economic environment. Particularly important for mutuals is small, still beautiful. I talked yesterday to the Chinese delegation. They allow, as you know, they allowed the use of the mutual legal form for insurance in China. But as supervisors, they are reluctant. They're reluctant. How did that work, you know? Can a small insurance company like some of the mutuals, can they be operational? Can they be good market operators? And I try to convince them because in Europe we do have them. I mean, they're present in this room. Small, medium-sized, large companies. There is room also for the smaller operators in niche markets. What does proportionality mean in practice? It doesn't mean quite clearly that the rule doesn't apply, but to what extent can it be moderated or modulated? How can you convince your membership that the world has changed? It's very important. That's a question of change management. The future. You said it yourself. I confirm it. Your sector has a brighter future than the banking sector. The bankers have had it, ladies and gentlemen. The insurers are there to come. But the condition is, of course, that you start to continue ensuring that you're innovative and that you put the consumers first. We have heard that this morning, we have heard it yesterday. Consumers are attracted by the proposition that an insurer is offering a product and that if the insurer is making a profit, that the profit goes back to the consumers. I mean, that's an attractive proposition today more than even it was in the past. But there's some challenges here. Individualization, the whole big data, we heard it this morning. The whole big data, what does it mean? Does it mean that insurance will be so specific as we saw with this watch, you know? We know everything. You had 3 duvels yesterday. Oh, terrible. Your life insurance premium will go up, skyrocketing, because you also had some Belgian pommes frites in addition to that. So that is an issue. Individualization of the risks because of big data. But at the same time, what we see, and that's very important, that people are forming communities that approach the insurers and say, we want you to develop for us pooling of risk. Very interesting because the mutual ID comes back. Profit seeking. What we see today is that this idea of making a quick profit, some people are reluctant to accept that. And they will stress it's important to look at the common interest of the people. Short-term versus long-term. That's a very big issue today towards sustainability. I'm sure that going forward, sustainability will become also politically a very important issue, and insurers are long-term people. There's a big difference. I know when I talk to the bankers wanted to make money yesterday. The insurers say, well, we'll see. We'll take our time. Continue doing that. That is very important. Is there still future for the mutual business model? I think mutual model corresponds more closely to what insurance really is. But it is very important, ladies and gentlemen, that you continue to provide insurance. What I see happening in the market today is that more and more insurers become asset managers. That is not insurance, ladies and gentlemen. And if you become an asset manager, you will be dealt with like a banker, also for capital purposes. So it is important. There is a need in the market for insurance product innovation. That is very important. And the present economic climate should help you doing that. And we heard this morning what is likely to come up in the future. The business model will work, two basic conditions. And you say, you can ask me, why do you say it for the mutuals? It's of course also true for insurers in general. You can no longer, as some insurers did in the past, provide insurance without proper risk assessment. So risk management is going to be a key issue in the years to come. And it's not easy, because who can predict the future? How can we predict the risks of tomorrow? Long term is a very complicated issue. Need for proper governance. We've seen that in the past, even insurer got into difficulties. It was not so much because of a lack of capital. And again, you confirmed that, ladies and gentlemen. Because capital is not your main worry. But it was because of a lack of proper governance. And I think that's true in any insurance company, but also in mutuals. Because of the particular structure, it may be even more challenging to organize that. We are going to talk this morning in this panel about risk mitigation techniques. If you need capital, one way to reduce the capital requirements is to reduce the risks. And you can do that through securitization. You can do that through reinsurance. You can use that by using derivatives. But the first thing is that you know your risks. Because risk and capital are interlinked under the new solvency regime. And how can you do that? By doing an ORSA. I know you're all familiar with ORSA. If you aren't, your place is not in this room. Own risk and solvency assessment is very important. And don't look at it as a regulatory toolkit or playground for your supervisor. No, it is for yourself to know what your risks are. Once you know your risks, you match them with capital. And then you see, do I need to use securitization? Do I need to reinsure part of my business so as to transfer some of my risks? Risk management, key feature of Solvency II. Mutuals and the capital structure. I can quote Gabriel. Mutuals cannot invoke proportionality in order to operate with less capital. Capital goes with risks, independently of the operator and the legal structure of the operator. The capital buffer is necessary to protect the policyholders. That's what it is all about. And that's why we need to be careful. If you are gaming the system, it's not going to work. Solvency II is about matching risks and capital. You can optimize your capital position. There are many techniques to do that. I'm sure you're familiar with them. You can de-risk your balance sheet, reorganize your investment portfolio. You can issue subordinated debt, also a technique that offers you capital opportunities without necessarily having outside capital into the business. Risk mitigating instruments, we've talked about that. Structural changes in the group through holdings and providing a way to bring outside capital in, and cooperation also between mutuals and other insurers are ways in which you can actually provide a more heavy capital structure. To conclude, the world has changed and is likely to change more quickly than ever before. And we saw that yesterday. We're trying to, in these questions, you remember that question? Is it going to take 10 years? Ladies and gentlemen, it's going to go more quickly. Do I want that? No. Because the problem of change is how to manage the change. But unfortunately, we live in a world that is changing, and we need to adapt that, and we need to think and be flexible in our way to deal with these challenges. And I think a mutual that is thinking about potential changes and is flexible in the way to approach that is the winner of tomorrow. Putting the customer first is a proposition that mutuals can use as an important marketing tool. Insurance, ladies and gentlemen, is the great unknown to anybody outside the insurance sector. How many times did I have to explain to my commissioner that there is a linkage between a risk and a premium? People don't know that. There's nobody outside this room that knows that they will have to pay more if they're more risky. You know that. They don't. But please don't forget that they don't know. in your language and your communication with the market. Knowing your customer and addressing his real needs, that's the future. And again, it's because times have changed. The regulation today is focusing more on consumer protection than ever before. Because of some mis-sellings, particularly in the area of investment products, and that's why you all hate this MiFIDs and the PRIPs and the PREIPs and whatever you call these animals, this terrible regulation. A lot of rules, ladies and gentlemen. But that's the result of some problems in the market where people have lost money, and you know how that happens. Then politicians come in and they will force the rules to be issued. So for you, the message is, if you put the consumer first, it's less likely that the regulators will have to intervene. And again, new regulatory developments, ladies and gentlemen, you don't like that. Because again, we have to have these new rules and we have to learn all these things. But again, they provide opportunities for innovation. And I see that in the market. In the beginning, people were saying, oh, all these problems and so on. But some people are seeing the light. In Belgium, sometimes difficult to see the sun between the clouds. But look for it, ladies and gentlemen. Look for this opportunity, because if you are the first, you're the winner. And that is why I agree with you that the future for the mutual model is still bright in the years to come. And that was my conclusion.